All right, let's jump right in. We all tend to think the biggest risk in investing is some crazy volatile market, right? But what if I told you the single greatest threat to your financial future is actually you? Today, we're going to explore something called the behavioral gap, and we're going to do it by following the all too relatable story of one investor's wild ride. So, our story kicks off like a lot of financial stories do, both the good ones and the bad ones, with a windfall. I want you to meet Julian. He's a really smart software architect. One morning, he wakes up, checks his bank account, and sees this beautiful number, $15,000, a performance bonus he wasn't totally expecting. Now, just pause and think about that for a second. That money lands in your account. What is your gut reaction? Your first move? Do you think, great, I'll pay down some debt? Or maybe I'll invest this for the long term? Or does it feel a little different? Kind of like play money? Now, logically, Julian knew exactly what he should do. Put it towards his student loans, maybe his retirement account. But his brain wasn't really running on logic right then. This bonus just felt different. It felt like found money. And that, my friends, is where the trouble always begins. This brings us to our very first cognitive bias, mental accounting. It's this weird little quirk where our brains create these separate buckets for our money. The salary we earn, that's serious money. It's for bills, for savings. But a bonus, or a small inheritance, that often gets mentally filed under fun money. And you know what happens when we're playing with fun money? Our tolerance for risk suddenly goes right through the roof. So instead of firing up a spreadsheet, Julian opens his brokerage app. And right there, sitting on his watch list, is this hot, speculative stock called Aerolith. It's just buzzing all over the investing forums, full of hype about some revolutionary new technology. This is the thought just screaming in his head. He's seeing a tidal wave of rocket ship emojis, posts from people with names like To the Moon 88. He's experiencing a powerful, powerful fear of being the only one left standing on the platform while the train to Richesville pulls away. And this bias goes way back. I'm talking deep in our evolution. 10,000 years ago, if you saw everyone in your tribe suddenly start running, you didn't stop to ask why, you just ran. It was a survival mechanism. But in today's financial markets, that exact same instinct to just follow the herd can lead you straight off a financial cliff. And this was Julian's justification. He sees the stock has dropped $10 from its recent peak, so in his mind, he's not spending $45 a share, he's saving $10 a share. It feels like it's on sale. Let's just pause on that for a second. Was his logic actually sound? Was the stock's value based on anything real? Or was he just reacting to a number he saw on a screen a couple of days ago? This is a perfect textbook example of anchoring bias. Julian was mentally anchored to that recent high of $55, not the company's actual value, which, by the way, was probably closer to $5. That $55 price point became this totally arbitrary reference that made any lower price seem like an incredible deal, no matter what the company was truly worth. And with that thought, he taps buy. And for a few days, it actually works. The stock shoots up to $60 a share. Julian is feeling like a certified genius. The dopamine hit is real, and it reinforces his belief that he made an absolutely brilliant call. He feels invincible. This is when his friend Alina, who happens to be a risk analyst, enters the picture. Think of them as two different operating systems for the human brain. Julian is running on System 1. It's fast, emotional, totally intuitive. Alina, on the other hand, lives in System 2, slow, analytical, and logical. She takes one look at Aerolith and sees a complete house of cards. So Alina tells her, dude, you gotta sell. This company has zero revenue. But Julian isn't listening. Not really. He's deep in the clutches of confirmation bias. He's actively searching for articles and forum posts that say Aerolith is the next big thing, and he just scrolls right past any skeptical analysis. His brain isn't looking for the truth anymore, it's just looking for validation. And then the tide turns. A devastating report comes out, accusing Aerolith of basically faking all their research. The stock immediately starts to collapse, and Julian's emotional high transforms into a gut-wrenching panic. Just look at how fast this thing falls apart. On day 1, the stock peaked at $62. That report hits. By day 8, it's down to $48. Day 9, $40. By day 12, it's cratered to $28. In less than 2 weeks, he's not only lost all his gains, he is deep in the red. But here is the most important part. He doesn't sell, because selling would mean he has to admit he was wrong. This is loss aversion in action, folks. Our brains are hardwired to hate losing far, far more than they enjoy winning. In fact, research shows that the psychological pain of losing $100 is about twice as intense as the pleasure of gaining $100. So to avoid that intense pain, Julian just holds on, praying for a miracle. This is the dangerous rationalization that almost always comes next. He's underwater, so he decides to double down. He pours the last $5,000 of his bonus into this failing stock. His logic is if he can lower his average purchase price, he won't need the stock to recover nearly as much just to get back to even. Oh, this is the classic sunk cost fallacy. The money he already put in, it's gone. It's a sunk cost. It should have zero influence on his next move. The only rational question to ask is, based on everything I know right now, is this stock a good buy today? But he's not asking that. He's letting a past mistake dictate a future decision, just throwing good money after bad. This stock just continues to bleed out. It hits $15. Julian's entire $15,000 investment is now worth about $4,500. He's not sleeping, he's barely eating, he is completely trapped. And that's when his friend Elena shows up at his store. Elena doesn't scold him. She just reframes the entire problem with this one incredibly powerful question. She forces him to completely ignore the past and evaluate the decision based only on the present. Would he take $4,500 in cash right now and buy this train wreck of a stock today? Of course not. No way. So he clicks the sell button, and something really surprising happens. He doesn't feel devastation. He feels this immense weight just lift off his shoulders. The mental energy he was burning trying to rationalize his bad decision was exhausting. And now, finally, the uncertainty is over. The post-mortem on this whole thing is crucial. Julian realizes the lesson isn't just don't buy speculative stocks. The real lesson is that he can't trust his future self to act rationally when emotions and dopamine are running the show. He needs a system. So what does he do? Well, Elena helps him create what's known as a Ulysses contract. It's named after the myth of Ulysses, who literally tied himself to the mast of his ship so he could resist the deadly song of the sirens. In the same way, Julian builds a system to protect his future self from temptation. He automates his savings, he makes the boring choice the default choice, and he even signs a contract with Elena promising to put 90% of his next bonus towards his debt. Ultimately, that gap, the difference between how an investment performs and how an investor performs, it all comes down to conquering our own biology. The game isn't rigged, but the player is definitely flawed. The market is always going to be volatile. The real question is this: have you built a system to protect your portfolio from your own worst instincts?